Goldman Sachs filed with the SEC on April 14th to launch its first ever Bitcoin product, a $3.65 trillion asset manager, the biggest name left on the sidelines, finally in. On the same day, Morgan Stanley had already debuted its own spot Bitcoin ETF. Bitcoin bulls immediately read it as validation. Wall Street is capitulating, and the price follows. Except the filing doesn't say what people think it says. The Goldman Sachs Bitcoin Premium Income ETF will hold at least 80% in Bitcoin exposure, but that's where the headline ends and the strategy begins. The fund's core operation is a dynamic options overwrite. It holds long positions in spot Bitcoin ETFs while simultaneously selling call options against them, collecting the premium as monthly income. The overwrite level ranges from 40% to 100% of the Bitcoin position, adjusted based on market conditions. In plain terms, Goldman is not betting Bitcoin goes up. Goldman is selling upside. Every month, the fund pockets premiums from investors who want leveraged exposure to Bitcoin price gains. The fund collects that cash and distributes it as income. When Bitcoin surges, the fund doesn't capture the full move. It captures the premium it sold. One analyst at Benzinga dubbed it boomer candy. That's not a compliment to the bulls.
The instinct is understandable. Goldman's entry feels like a door opening, and in a narrow sense, it is. Goldman is now inside the Bitcoin ecosystem in a way it wasn't yesterday. But the nature of the entry matters enormously, and this one is structured to serve a specific type of client. The Goldman Bitcoin Premium ETF is designed for income-seeking investors, pension allocators, wealth managers running conservative portfolios, retirees who want yield without losing sleep over drawdowns. It does not require those clients to believe Bitcoin will rise. It only requires them to believe Bitcoin will stay volatile. Selling options earns more when volatility is high. The product is, structurally, a bet on continued turbulence, not a directional bet on price. That distinction reshapes the signal entirely. When BlackRock launched its spot Bitcoin ETF in early 2024, it was genuinely bullish, pure long exposure at scale, meaning every dollar in was a dollar bidding up the spot price. The Goldman product is different. Capital flowing into a covered call fund does not create the same demand pressure on the underlying. The fund buys spot exposure, yes, but it also sells future upside. Net effect on price, far smaller than the headline implies. There is a second layer. The overwrite level can go as high as 100%. At maximum coverage, the fund is fully hedged against price appreciation. It becomes effectively a yield vehicle with Bitcoin-flavored volatility as its raw material. Goldman is harvesting what retail investors are willing to pay for the dream of 10x gains and converting it into steady monthly checks for conservative allocators. Wall Street is monetizing Bitcoin mania, not joining it. The filing lands the same week Morgan Stanley debuted its own spot ETF, and markets read the confluence as a tide turning. But one product is unambiguously directional, the other is a yield extraction engine. Conflating them overstates what Goldman's entry means for Bitcoin demand.
If more institutional entrants follow Goldman's template, options overlays, income structures, volatility harvesting, the implication for Bitcoin is counterintuitive. Institutional adoption grows, flows into the asset class grow, but upside suppression also grows because every covered call fund actively sells the ceiling. Volatility could compress over time, which would, ironically, reduce the premium income these funds generate and make the product less attractive to launch. That said, the bearish read on this has a limit. If Bitcoin's spot price moves sharply higher, regardless, driven by the base demand from BlackRock's iShares Bitcoin ETF, which crossed $50 billion in AUM last year, or by sovereign-level accumulation, then the income fund overhang becomes noise. Price momentum can overwhelm options market friction. The one number to watch, Bitcoin's 30-day implied volatility index. If it holds above 50, the Goldman product generates meaningful premium, and more banks will file similar structures, adding to the covered call overhang. If implied volatility drops below 40, the income case weakens, the template becomes less replicable, and Goldman's entry looks less like a category launch and more like a one-time product. Tomorrow's early Bitcoin options market pricing will be the first read on whether the market has absorbed what Goldman actually filed or is still reacting to the headline it wanted to see.